Hello, everyone, and welcome to today's Strategic Source webinar. This is David, your session producer. Withum Advisor Tax is our sponsor guest today, and the topic is latest updates to ERC from eligibility to audits. And Doug Austin will be on in just a moment for some opening comments. Doug, I'll turn it over to you right now.
Thank you, David. Well, welcome everybody. We're happy you joined us today. We've got a really informative session today talking about the ERC tax credits. I'm sure you folks are probably have participated in that, but if you haven't, there are certainly opportunities to do so that you'll learn more about today. This session, an innovative webinar session, we began about 2 years ago, a little over 2 years ago. And it's our objective really to identify innovative suppliers who have a unique approach to a business expense or audit and recovery category opportunities, and sometimes even new revenue opportunities. It's our desire to bring those suppliers to you and to introduce them to you for you to consider and engage if appropriate. So we've done a little, I think more than 50 of these now. The attendance continues to grow, and we welcome you back for future webinars as well. But with that, I'm going to turn it over to Louis and Sebastiano of Withum. Take it away, guys.
Thanks a lot, Doug. Thanks a lot, David. We will be going through the latest updates, as Doug and David said. We'll be covering some of the latest updates, and we'll be talking to you about the process and what's going on as far as the IRS coming in and looking over these and what their responses have been. So this is a little bit about Withum. We're certainly active in all industries, all niches, and any tax advisory or accounting questions that come up, we certainly can cover. But our real strong point in the last few years has been with the PPP SBA loans and the ERCs. We've done a lot of work and have been the source of a lot of information for these topics. So any ERC questions that come up, for sure. And again, we're advisory, tax, accounting, and we have Withum Wealth to address any wealth or savings issues that you may have, investment issues. And again, myself and Sebastian will be updating today. Why don't we get started, Sebastian? So Sebastian's going to go through the first few slides, covering an overview, and then I'll step in and talk to you about some of the specifics.
Thank you, Lou. Thanks, everyone, for joining us. Thanks for the intro, Doug and David. So, as Lou mentioned, we're going to be speaking about ERC, current issues, what we've learned since the introduction, and just kind of cover a few of the basics as well as a memory refresher. So there's 2 ERC credits that are eligible, one for 2020 and one for 2021. So to be eligible for 2020, the business had either have been affected by either a full or partial suspension of operations, also known as shutdown, or there had to be a drop in quarterly gross receipts when you compare the quarter of 2020 to a quarter of 2019. Should have been a drop of 50% or more. Those are one of the 2 eligibility requirements, 2020. The period that's covered, that's looked at, is March 13th, 2020 through December 31st, 2021. 2020. March 13th, it represents the date of the beginning of the suspension of business due to COVID. We also look at qualified wages. So for tax year 2020 or the ERC 2020, we're looking at up to $10,000 of qualified wages per employee for 2020 as far as qualifying for ERC. Now, when you contrast that to 2021, for 2021, the eligibility could again either be full or partial suspension of operations, or we look at the quarterly drop in gross receipts comparing quarters 1, 2, or 3 of 21 to quarters 1, 2, or 3 of 2019. The difference there is it's a 20% drop, more than 20% drop, as opposed to more than 50 for the 2020 credit. The 2021 ERC also looks at January 1st, 21 through December 31st, 21, which is a full year for their wage period. And the qualified wages, again, are up to 10,000 of qualified wages. However, it's looked at on a quarterly basis as opposed to through the whole year. So you can qualify for the ERC up to 3 times by looking at 3 quarters, theoretically. Lou, can you give us a little insight on the eligibility as far as using in 2021 using the previous quarter, Q4 2020?
Yeah, and we'll get into this in some detail, but there's a unique opportunity for 2021 first quarter. You are allowed to look at the fourth quarter of 2020 comparing to the fourth quarter of 19. And if there's more than a 20% drop off, you get to apply for the credit in 2021 first quarter. So that's a little, and again, we'll talk about that some more as we move forward, but that's a little quirk in the rules and regulations.
So the way the credit amount is computed is in 2020 is based on 50% of the qualified wages. So a maximum of up to $5,000 per employee per year. As far as 2021 is concerned, the qualified wages of 10 grand, you can use up to 70% of those wages per quarter, meaning quarter 1, 2, and 3. So whereas in 2020, you could qualify up to $5,000 per employee per year, on the 2021, you can qualify up to $21,000 for an employee, if ideally you can get $7,000 per quarter for that employee. So the 2021 credit is definitely more generous than the 2020 credit.
Yeah, and there is a little tail at the end of the year if you're a startup company. So if you started up in 2020 and you have gross receipts of less than $1 million, you might be able to qualify for a credit in the fourth quarter. Generally, there are restrictions to that, but only in situations where you started up after February of 2020.
And is that credit capped at 50 from what I understand?
That's capped at 50. That's correct. 50,000.
So we also need to understand what is a covered employee, which means not all employees may be covered. So when you're looking at the 2020 credit, if the company had less than or equal to 100 employees in 2019, full-time employees, then all the wages of those employees could be considered for the employee retention credit. If the company had less than 100 employees working in 2019, then only the wages of the employees that were paid to stay home. So you were paying an employee, but they were not actually coming to work. Only those would be looked at.
More than 100. More than 100.
I'm sorry, more than 100. Got it backwards. So
Right.
Thank you, Lou. Now in 2021, criteria changes to less than or equal to 500 employees. Then you look at all the wages. If it's more than 500 employees, then only the wages of those employees not providing services. So again, the covered employee changes from 2020 with 100 is that threshold of how we qualify or treat or classify a covered employee. And in 2021, that threshold jumps up to 500. PPP. So you can get the credit in 2020 or 2021. You can apply for the credit even if you applied for PPP funds. However, the wages that were used to qualify for the PPP loan forgiveness cannot be used to qualify for the ERC. So those are kind of figured out of the calculation, and whatever remaining wages are left over will then be considered towards the credit calculation.
And that's where it gets tricky if you're trying to do this yourself, trying to figure out the mix between the wages that you can use for PPP and reconciling that to the wages that you can use for the ERC. So that's something to consider if you're looking at this opportunity.
So let's speak a bit more about, or touch up a bit more on qualified wages. So again, recap of what we'd said. For 2020 ERC, we're looking at the pay period March 13th, 2020 through December 31st, 2020. Qualified wages are up to $10,000, which includes payments, cash wages to employee, plus qualified health plan expenses paid by the employer. And there's no dollar limit or cap on qualified wages like there was with PPP. If you recall, PPP, I believe, had a $100,000 cap when determining the PPP calculations. With ERC, there is no cap. So whether your employee made 50 grand or 150 grand for the year, they were included in this. They could still be looked at for purposes of qualifying the wages. For 2021, again, the period we're looking at is January 1st, 21 through September 30th, 21. So no 3 quarters here, first 3 quarters. Again, it includes up to $10,000 per employee in cash wages and qualified health expenses paid by the employer per eligible quarter. Again, this is a key difference between the 2020 and the 2021 ERC. In 2020, we're looking at $10,000 per year. In 21, we're looking at $10,000 per quarter, per eligible quarter. And again, no dollar limit or cap on the qualified wages. Whether Joe makes 10 grand or 50 grand or 150 grand, he could be considered eligible if he qualifies. Exclusions. Exclusions could be a tricky one, but generally speaking, wages paid to related persons who are greater than 50% owners would be excluded. Certain severance payments would also be excluded, depending on how the employees or the termination status of the employees. Lou, any thoughts on the exclusions?
Generally, we're looking at, as Sebastian said, any relatives to shareholders would be excluded, and any severance pay to former employees after their employment. If you've got payments made to them while they were still employees, that's included, but any severance after the fact would not be included. And then, of course, independent contractors. We see that a lot. You know, if you're not on the payroll, you're not getting a W-2, you can't qualify for, eligible wages for the ERC.
So Lou, there's a lot of terms here: independent contractors, eligible wages, related parties. So clearly, we're getting into the weeds here. And having the right qualified accounting firm that understands the technical language coming down with all this is key to getting into the nuances and really determining what qualifies and what doesn't, what's eligible and what's not eligible.
Excellent point, Sebastian.
So besides the exclusion, well, not besides exclusion, but if we're qualifying a business based on full or partial suspension test, then the qualified wages that we're looking at include the wages during the period of suspension, not the quarter. If we're qualifying based on the gross receipts test, then we look at the qualified wages for the relevant quarters, the quarters that actually qualify under the decline in gross receipts. Key eligibility differences. Again, both the 2020 and the 2021 do consider the full or partial suspension test. Both the 2020 and 2021 do consider reduction in gross receipts, but one key difference is, or maybe two here, is in 2020, it's greater than 50% reduction. And in 2021, greater than 20% reduction in gross receipts. And Lou, can you elaborate on utilizing the prior calendar quarter?
Yeah, again, we're getting
21?
we're getting into the weeds here. We talked about it briefly. If you qualify for the 20% reduction starting with the fourth quarter of 2020, you get to include the following quarter. So let's say you qualify in the first quarter of 2021, you automatically qualify for the second quarter of 2021. So that's, again, the nuance in the rules and regulations that allow you to take advantage of two quarters, even though you qualified for just the first one.
Thank you. So I think we're at our first poll question. So the poll question is, the cap on qualified wages for 2020 is A, 10,000 per year, B, 10,000 per quarter, C, 50% of wages, or D, 70% of wages. I'll give everyone about 10 more seconds. So it looks like we had about 50% pick 10,000. Correct answer is A. A is the correct answer, 10,000 per year for 2020.
So it doesn't matter whether you have $30,000 or $50,000, you're capped at 10,000, and those are your qualified wages that the 50% is applied to. 50% in 2020, 70% in 2021.
So first test is, or one of the tests is declining gross receipts. So again, if the quarterly drop in gross receipts is more than 50% when you're comparing the same quarter in 2019 versus 2020, then that qualifies you to meet the test. Could be any single quarter and does not need to be related to COVID-19. So what that means is not related to COVID-19 is basically there's actually some areas, believe it or not, that were not affected by COVID, but the way the rules and regulations were written, if they had this decline in gross receipts and passed this test, then they technically qualified for this ERC. In 2021, again, the quarterly drop in gross receipts has to be more than 20% compared to the same quarter in 2019. And again, can be any single quarter and does not need to be related to COVID-19. You just need to demonstrate that you had a drop in your gross receipts. Lou, you want to talk about the other test that we use?
Sure. So as you mentioned, there's two ways to get this, two eligibility tests. One is the gross receipts test. One is the full or partially suspension test. And again, we're looking for a government order that drives the suspension. And typically, we're seeing government orders that limit commerce, travel, group meetings, typically affecting the operations of a business. And what you see for the most part with the government orders, businesses being lumped into essential or non-essential businesses. So if you're an essential business, you do have to stay open. If you're a non-essential, basically during that period of time, you're closing your doors and you're either working from home or you're limiting your commerce to a great extent. Now, this has to have more than a nominal effect on your business for you to take advantage of this. And we'll talk about that in a little bit. But one of the nominal effects that the IRS looks to is 10% of your gross receipts or 10% of your total hours. So if you have more than 10% drop off in your gross receipts, the IRS considers that to be a nominal effect. And again, this has become an issue as we move into the audit parts of this program, where the IRS is coming out and auditing businesses who filed for an ERC based on this eligibility. Next slide. So what are the examples we're talking about? Restrictions, seating capacity restrictions, reduction in hours, orders prohibiting suppliers from making deliveries, partial closures of operations. No negative surgeries would be a good example. And again, these are specifically itemized in the rules. So these aren't phrases that we're making up. These are what the IRS is looking to. And again, these examples have to have some nominal effect on your business. And the things that don't meet the test are, the ability to work through telemarketing or any type of telework capacities that are available that allow basically the business to keep operating. Also, the IRS has been very strict on this. You wouldn't meet the test if you're able to operate, but sales go down due to a reduction in demand or loss of business or customers. This is something that we're going to talk about a little bit more, but it's unfortunately something that you need to think about if you are going for a partial suspension eligibility test. And then one thing I wanted to say to begin with, this program is evolving as we speak, literally. And, what we looked at 3 months ago, 6 months ago, and what we're looking at today has certainly been clouded by the fact that the IRS is spending so much time looking at the ERC program. So, definitely buyer beware. You might want to just double check, make sure you're eligible before you go ahead and apply for the ERC, and we can certainly help you along those lines. Go to the next slide. So what's the definition of gross receipts? Gross receipts are basically sales. Let me make it very simple. Total sales and other income. Other income can include investments, other things that you would have in terms of below the line income, rent, interest, royalties, anything like that in addition to sales would be included as gross receipts. Obviously, it doesn't include cost of goods sold, but it does include any capital gains. So if you have a sale, an asset sale, you would be able to reduce that asset sale by any basis adjustment. Next slide.
I just wanted to chime in there, Lou, as well. PPP forgiveness funds are also not included in gross receipts testing. So when one is testing those gross receipts, we need to, and there are PPC forgiveness funds in those receipts, we need to make sure to take those out of the equation for purposes of this calculation.
And of course, it would be best to retain this information probably for at least 4 years. So in a lot of cases, you should expect the IRS to be knocking on your door if you got an ERC. So let's talk about these aggregation rules a little bit. And again, we don't want to get too deep here because it gets a little cumbersome. But generally, if you own more than one business and you own more than 50% of several businesses, you have to aggregate those businesses when you're looking at the gross receipts test, when you're looking at full or partial shutdown, when you're looking at your employee count, So what's the number of full-time employees you had in 2019 for those aggregated businesses? And again, you're determining the maximum credit per employee. You're not. So that's all important in terms of making sure you look at all of the businesses that would fall under the aggregation. And again, there's parent sub relationships, brother, sister, different types of corporations, partnerships. All of these would be subject to this test where you have a owner who's got more than 50% of more than one entity. The ERC must be apportioned among the group members based on the proportionate shares of qualified wages given rise to the credit for each calendar quarter. So again, the aggregation is something that we just want to touch on. We don't want to spend a lot of time on it, but you should be aware that it's out there. I think we have. And the other thing we want to point out is full-time employees. This is much different than the calculation for the PPP. Under the PPP program, it was a full-time equivalent. So you might have 3 employees or 5 employees under the PPP that worked part-time. You would add them up to get to maybe 2 or 3 full-time equivalents that you would apply for using the qualifications for the PPP. With the ERC, it's pretty straightforward. We're only looking at full-time employees. So in order to hit that 100 mark for 2020, we're looking at employees that averaged more than 30 hours a week or 130 hours a month. Any part-time employees are not included in the calculation. So you could have 50 full-time employees and 100 part-time employees, and only your full-time employees would be used to meet the qualifications or the eligibility test. So that's very important. Next slide. And we talked about this a little bit, the taxation of the ERC. What is taxed? The income's not taxed, but what you have to do is you have to reduce your expenses for wages. Whoops. Can we pop back to the master slide, Sebastian?
Just a moment, Sebastian. Let me get to the right spot for you.
There you go.
And what number slide do we need to go to?
Probably close to 20.
Okay.
That's it right there. 26.
26. Okay, just a moment.
There you go. So the ERC amount is taxable. What you need to do is you need to go back and amend your tax returns in either 2020 or 2021. And what you would be doing is you would be reducing your wage expense in that given year, which would basically increase your net income, and you would have to pay tax on that difference. So that expense disallowance would apply, and your tax would go up in the respective years that you get your ERC. And again, we can talk to you about that in this process if you decide to go forward with it. And how do you claim the ERC? So basically what you're doing is you're going back to the relevant quarter and you're amending the 941 that you filed. So you probably either filed it yourself or your payroll company files the 941s for you. There's something called a 941X, and in each quarter that you qualify, you would go back and amend that quarter using the 941X, and that would allow for the credit to become a refundable credit that would be mailed to you. It's not a simple process, but it's a process that your payroll company should be aware of. Believe me, the top 8 payroll companies have been doing this for millions of businesses in the United States, so they're comfortable with this this process. Another poll question, Sebastian.
So the request for ERC is handled by A, filing with SBA, B, filing amended tax returns, C, filing amended tax return 941X, or D, none of the above.
Filing an amended tax return, 941X. Let's move along. So let's talk about some of the current issues. We're basically talking to a lot of businesses about this, and what we're seeing is everybody's being inundated by emails and commercials on the radio and regular mail and people marketing, and a lot of companies have come out of the woodwork and have suggested that everybody's eligible, or you can be eligible for this and that. You really have to be careful with, buyer beware. You really have to be careful with some of the advice that's being given out there. Unfortunately, there's a lot of legitimate, reputable companies out there, but there's others that aren't. So, this is something where, you just have to take the smell test or look at it and see, does this make sense? All right. Is this something that I think we can do? And so if you go to the next slide, what exactly are they talking about, and what exactly would allow me to qualify? And as we get into the IRS current situation with the audits, you're seeing that any of these type of eligibility items that they're throwing at you, you really need a government shutdown order. The government shutdown order is key to any type of qualifier as far as the IRS is concerned. So, you have to have this shutdown order, and it's got to affect your business by more than a nominal amount. And what you'll see is a lot of people, fortunately for them, their gross receipts went up in a lot of cases. Not everybody, but in some cases, the gross receipts went up. So you have to be careful thinking about taking any type of partial or full shutdown in a situation where your gross receipts went up. It's not going to be looked upon favorably by the IRS if you are audited. Next slide. So what are we seeing in the audits? We're seeing a few things. A lot of things that we talked about. How many employees do you have? Do you have less than 100 employees in 2020? For 2020, looking at an average for 2019. Is there any aggregation involved? The first thing they're going to do is they're going to look at your tax return, and they're going to see how many K-1s you have. Are there any other businesses that should be included in your gross receipts check? So very important. You want to make sure that you're dotting your I's and crossing your T's when you're looking at this. They also want to know who did your calculation. Unfortunately, the IRS has a number of other advisors out there, other companies on their list. And if you're using one of those, you have to be careful. The IRS may ask you more than one question with regard to how is it that they did your calculation and whether you qualify. So that's very important. And again, did you calculate? Did you take everything into consideration? Did you not include PPP wages in your calculation for wages used under the ERC? Did that, was that done properly? So there's a lot to it with these audits. And again, buyer beware if you're not with a reputable company that's doing this calculation for you. Next slide. just talk about the SBA a little bit. Next slide. There's a lot of activity with the SBA in terms of auditing the PPP loans. At this point, over 90% of the loans have been forgiven. The SBA has got a model out there where they're filtering through these applications and they're picking out irregularities with a filter. So, you might get a request for information from the SBA based on this computer model. They're going to ask you a bunch of questions, just making sure that you did everything properly. And at this point, we're seeing them also audit the SBA loans. There aren't as many SBA auditors, but they probably hit close to 5% by now. Some of this information is a little dated. Next slide. Yeah, again, these are things we've talked about. Eligibility is important. Location is important. How did you come up with your gross receipts? Very important. What did you include? What did you not include? Again, our presentation goes into what you can include or not include for your gross receipts amounts. And again, you have to demonstrate that there was a nominal effect on your business. So what are they looking at? They're looking at, was there a reduction in your hours? Was there a reduction in your gross receipts? What is it that you can point to that would prove that you had some restrictions that presented a more than nominal impact on your business? So that's very important. And unfortunately, it's an area that the IRS is keying in on. So with that, I think we've our 45 minutes. With that, we'll open it up to questions. David, Sebastian?
Sure. Everyone, you can use the Q&A button at the bottom of your screen to ask questions for Lou or Sebastiano, and those we'll cover as many of those as we can during the remaining time. Here's one. Does Withum provide assistance in calculating the employee retention credit?
Yes, and of course the answer is yes. We've done thousands of these for businesses. We've also been involved in hundreds of audits. So we're looking at making sure that you're eligible, and we're also looking at folks who may not have been eligible and have to consider what the next step is with regard to that. So it's something we're very comfortable with. We've got dozens of articles out. If you want to look and Google any articles on what we've talked about, you're welcome to do that as well. Anything else, David?
Yeah, here is another. What is the difference between full or partial suspension?
So a full suspension would mean your entire business is shut down. So in the orders, usually you're getting orders from the governor of the state, and what you'll see is a list of essential and non-essential businesses. But you may have a surgeon's office where any type of elective surgery would be considered non-essential, and regular surgery would be essential. So in that case, you do have a partial shutdown. Did it affect your gross receipts? Maybe, maybe not, but that's a partial shutdown. If you have an automobile dealership, the sales portion of the business was shut down during the service end of the business was open, was considered essential. So that's a partial shutdown where just the sales portion of the business is closed, where the service portion of the business is still open.
Again, reminding everyone, you can use the Q&A button at the bottom of your screen, type something in there, and we'll forward it along immediately. Otherwise, Doug, why don't I have you bring your webcam back up to provide some closing comments or additional questions?
Yeah, one of the questions I have for you gentlemen, Lou and Sebastiano, I was just at a trade show in Chicago probably 2 months ago, and I was just awestruck at the many companies that were there pushing the ERC tax credit. And in fact, we had one company right across from our booth that had more than one booth just at the restaurant show. So, and I guess within in knowing that this process has been going on for quite some time, is it your understanding that people just may not have applied at all to begin with, or they didn't realize that there were many more opportunities than they may have taken advantage of? What is it? Because I'm just baffled by the renewed interest. I'm getting phone calls probably a couple of times a week from ERC consultants. What's changed?
Well, not much has changed other than the IRS getting very specific on eligibility. The IRS has been very active in the last couple of weeks in putting out notices because, this is the golden egg here, and a lot of businesses perceive this as something that everybody's eligible for. You're absolutely right, Doug. I mean, this has really taken off as far as trade shows and radio advertising and
Television.
emails, marketing. It's absolutely incredible. And to that point, and again, I'm not a doomsday guy, but to that point, I spend a lot of time playing defense because I'm getting calls all the time from clients and non-clients who think they're eligible, but they're really not eligible.
Okay.
Let me just give you an example. For a lot of businesses in 2021, and this is not, I'm not talking about across the board, but for 2021, a lot of businesses saw growth in gross receipts. We had a bounce back economy, and there in most states there were not shutdown orders that were in place in 2021 to the extent they were in place in 2020. But what we did see in 2021, if you remember, is these supply chain disruptions, and there were a lot of supply chain disruptions, and a lot of these ERC shops are pushing the supply chain disruption angle for you being eligible for the ERC. And unfortunately for them, last week on Friday, the IRS came out with a very explicit explanation of supply chain disruption and how basically it would not allow you to be eligible for the ERC and what the stipulations are with regard to that. As I said many times during this presentation, everything ties back to a government order of some kind. And after September of 2020, it's, except for a few industries like theater and some of the schools, there really was a push after September 2020 to get businesses rolling again, especially as we got into 2021. So there are a lot of companies out there, a lot of ads on the radio, a lot of people looking at this, but please, buyer beware, be careful. It's got to meet the smell test. If you really had a bump up in gross receipts, you really have to think long and hard about whether you'd be eligible for the ERC, even though somebody is telling you you are.
And I would think you would endorse this idea, but tell me if you don't. Any company that has just set up shop in the past couple of years to take advantage of ERC, it's probably something you ought to take a look at with a jaded lens,
Right.
as opposed to a company like you that has been in business for many years on the advisory side. There's probably a little more credibility there than some of these startups.
Yeah, keep in mind, there's a couple things about these contracts. One, you're paying up to 20% of your ERC amount in fees. So that's a lot. That's a lot more than we would ever charge in terms of fees. And the second thing is, why is it that you qualify? When you sign a lot of these contracts, basically what you're signing on the contract is that I qualify. I know why I qualify and I qualify. It's not the ERC company telling you you qualify. You're telling them that you qualify. So again, buyer beware. Think about your situation and look at these contracts very carefully if you are exploring anything with some of these companies. Again, there's a lot of reputable ones out there too.
Well, Louis and Sebastiano, thank you so much. I think this is a very timely discussion given all of the press we're seeing, to your point, radio and television ads, telephone calls, the trade show presence of all these ERC companies. I think you're right. You need to be cautious and consider talking to an expert such as yourselves about whether, in fact, this is the opportunity is real. Gentlemen, thank you for a very informative session today. For everybody on the call, thanks for joining us. We appreciate your attendance, and we recommend that you stay tuned for further webinars on many different topics that Strategic Source will provide. If you're interested in help for your own organization, whether it's cost reduction, audit and recovery, maybe new revenue generation, give us a call. You can email us at sales@strategicsource.com or give Chris Austin a call, 612-386-3898. Thank you again for joining us, and Louis and Sebastiano, thank you very much.
Thank you for having us.
Thanks, Doug. Thanks, Dave.
All right, thanks guys. And I brought up the post-session survey, just 2 quick questions to get your feedback before you conclude today. It makes us better as we get your feedback. Thanks everyone for attending today, and we look forward to you joining us on future webinars with Strategic Source. Have a great rest of the week, everyone.